follow along with this question, please refer to the Unit 2 study guide. This demonstration will review the first-in, first-out method of accounting for inventory. When you look at the working papers in your textbook, it's divided up into 3 sections. And I like to think of the first 2 sections as part of the T account, or the general ledger for the inventory. The first part of the T account is for things that make the inventory account go up, and that would be inventory that you already have on hand, or beginning inventory. And to that, you would add your purchases. The second column is things that make your inventory go down, and basically that would be your sales. You have to remember that the sales have to come out of this inventory account at the cost price, at what we paid for the inventory. The last column is the balance column, and this is just the calculation of what we have on hand at any particular point in time. So let's go to a new screen and have a look at the question. The Beck Company has the following inventory purchases during the fiscal year ended December 31st, 2011. And the Beck Company has 2 credit sales during the period, and the units have a selling price of $135 per unit. When we're calculating the dollar value of cost of goods sold in ending inventory, the selling price doesn't come into play at all, so we get to ignore that number. In order to calculate the cost of goods sold in ending inventory using FIFO, we're going to record the transactions by date. It's really important to make sure that we're using a perpetual inventory system, and everything has to be sorted by date. So we're going to start with our beginning inventory. So we have our 3 columns. We have our purchases column, our sales column, and our balance column. Our beginning inventory, we have 500 units. And we purchased those for $90 a unit. So that means that our total purchases have a value of $45,000. Then on February 10th, we purchased some more goods. We purchased 250 units at $84 a piece. So the balance of our inventory at any point in time, remember this column shows that we would have 500 units from our beginning inventory, and it would also show this new purchase. Now the next transaction that happens is on March the 15th, and it's a sale, and we're selling 330 units. Now when we look at the balance column, we have 2 different groups of units that are available for sale. Units that cost us $90 a piece, and units that cost us $84 a piece. We have no way of knowing which units we actually sold, so the company has to make a decision about what inventory costing method they're going to use. This time we're going to use the FIFO method, first in, first out. So that means the first items that we got into our inventory are the first ones out the door. So it's important to keep the balance in order so that we can look at it and say, okay, the $500 that we had in beginning inventory were the first ones that we had in, so they're the first ones that we're going to sell. So the items that we're selling have a cost of $90 a piece. Now we need to update the balance. Now you can rewrite the balance. Your textbook examples will rewrite it. Personally, I just like to cross things out a little bit, and from the 500 units, we just sold 330, so we have 170 units left, and that would be a cost of $15,540. The next transaction is a purchase that happens on August 21st. The goods that we purchased 130 units at a cost of $100 a piece. So we're also going to bring that over to the balance column. So the balance column shows what we have on hand at any particular point in time. The purchases column, remember, shows what we have available to sell to our customers. The sale column shows what we've actually sold to our customers, but it's the cost. That's the cost of what the items were that we sold to our customers. On September 10th, we have another sale of 235 units. Now, I'm going to change color pen, and when we look at the balance column, remember we have to take first in, first out. The first ones we have in are the first ones out the door. So when we look at the numbers in the balance column, we can see that we had 170 units left from beginning inventory. So they would have a cost of $90 a piece. And we're going to, so these are all gone now. We've sold all of them. And we have to take the rest of the units from the February 10th purchase. So we need 65 more units to add up to the 235 that we're selling. And those 65 units are going to have a price of $84 a piece. To update our balances, we know that we started off with 250 at $84 a piece. We just sold 65 of them, so we have 185 of these units left with a new cost of $15,540, and we still have the 130 units that we purchased at a cost of $100 per unit. Now, this chart right here, we need to total up each of the columns to determine what we have in ending inventory, cost of goods sold, and goods available for sale. So remember, this first column is goods available for sale. That's the goods we have available to sell to our customers. And basically, if you add up all the units, we get 880 units. And those 880 units have a cost of $79,000. In the sales column, we're going to add up all the units that we sold to our customers. So that would be the 235 and the 330, so 565 units. And they would have a cost of $50,460. In the last column, the ending inventory column, we have the 185 and the 130, so we have 315 units on hand, and the cost of those units, $28,540. When you calculate the totals at the bottom, it also gives you a way to check your work, because if we take our goods available for sale in units and subtract what we sold, we're going to end up with our ending inventory. And if we take our goods available for sale in dollars and subtract off what we sold to our customers, we're going to end up with our ending inventory. So that's a way we can check our work.